We got a couple more minutes here, and then we'll get going. I just want to remind you, spring break is next week, and so the test for this first test will be the Tuesday after spring break. So I think that's the 16th or somewhere around there. Um, Also, the homework is due on that same day. I'd suggest probably getting the homework done next week while we're on spring break. That's probably you're gonna have extra time to do that, so I wouldn't put it off to the last second. Um, but uh, but before we jump into the material, in the first session, somebody asked a question about, how do I make my tests, or what do I use to write my tests? And that's a pretty good question. I figure I'll probably benefit from an answer to that as well. Um, Basically, what I do is I first go to my lecture guides and I look through them and I kind of think about, each page, and as I kind of go through it, like what are some ideas and calculations and journal entries and concepts that are important on each page. And so I kind of start there. So basically each, I'm going through things, and I'm um, trying to make sure that I stick to that lecture guide as best that I can whenever I'm asking questions on the test. And then from there, after I've done that, I've created the test. Usually at that point, that's when I start making practice problems and like these review problems, and even I assign the homework after I've written the test. Um, and so everything's kind of built off my lecture guide. So that's really the best place to go if you're wondering, what I'm going to cover. Really, the lecture guide's the way to go. Um, I will be available over break to answer questions. Yes, absolutely. So, I mean, my kids are still in school, so I'm not going anywhere or anything. So I'll definitely be available. I might not answer, right away if got something going on, but um, generally I will. All right. So let me sort of rearrange things a little bit. And all right, so I'll have the chat over here on my screen to the right. The first session ended a little before the time was up. I'm guessing the same thing's going to happen here. There's just 3 problems. They're not meant to cover everything that's on the test, but they're definitely meant to hit on some highlights, some things that are important, and some things you need to be thinking about. So this first question is dealing with a note in exchange for a copyright. And so there's kind of 2 benefits to this problem. One is it lets us at least touch on, when there's a non-cash transaction. And the second thing that's helpful is it's dealing with a 0 interest bearing note. And so both those things are important. They're going to be on the test on some level. And the other thing you should be aware of on the test, like here it says provide all journal entries. Well, on the test, I'm not going to have one problem with 3 journal entries. It's going to be more a part of a problem. So I'll give you some information, I'll ask for 1 journal entry or something like that, or I'll provide a framework and you have to fill in some numbers or something. So it's not fill in this huge text box blank kind of a problem, but that's how we're going to handle the review. But just know that the test is smaller chunks, smaller chunks. And so anyway, so when we have this problem, a couple of things that we're told right off the bat is we're actually told the present value of the note. And so the present value of this note is 113,000. Although we're told the estimated fair value of the copyright is 115. And really, the comparison is, which one is more reliable, the present value of the note or the estimated fair value of the copyright? And this is to those 3 levels that I talked about in the lecture guide, where there's level 1, which there are identical transactions to look at, level 2, similar, and level 3, unique. And this is comparing to those levels. And so with the note is due and its present value. That's a level 2 because debt is always comparable to other debt, and so that's a level 2. A copyright is unique, and so that's going to be a level 3. And what that tells us then is that the fair value, so the present value of the note, is more reliable than the estimated fair value of the copyright. And so this $115,000 estimated fair value is really irrelevant because it's not reliable. And so whenever now we move through with this journal entry and doing these calculations, really this 115 is not even part of it. Now it's the 113, the 123, and the length of time and all that stuff. And so anyways, that's important to understand. So the next thing whenever you have a note is you have to figure out, is this a short-term or a long-term note? And so um, we said that if a liability, a note payable, is being settled with existing current assets, then you can use the straight line method. But if it's not going to be using existing current assets, then you need to use the time value of money, which is the effective interest method. In this case, the note is due well over a year after it's issued, and therefore, by definition, it's going to be that non-current category. And so we just assume that when something's due outside of a year, that the existing current assets will not be used to settle it. And so all that to say, you must use the time value of money to solve this long-term note problem. And so let's kind of develop a framework. The other thing too is with a zero interest-bearing note, the N and the I/Y, they're always going to be in terms of an annual interest rate and an annual maturity. So anytime there's a zero interest-bearing note, that's the approach that we're going to take. If there are interest payments, then the N and I/Y are going to correspond to those interest payments. But in this case, there is no interest payment, so it's a zero interest-bearing note. And so let's just take the information and start filling it in. First of all, we're told that it's a $123,000 note. What that means is that the company, 49er Company, is obligated to pay $123,000 when the note matures. And so that FV, the future value of that note, is 123,000. So that's where the FV is. And I put a negative sign because that's a payment that the 49er Company is going to make. It is zero interest bearing, so the payment is zero. We're told that the present value is 113. Again, that's the most reliable estimate of the present value. So that's why it's positive 113,000, because we're receiving the copyright today. It's a positive economic flow. And then we don't have the I/Y, but we do have a way to get the N. It's issued on August 1st. It's due December 31st. And so the total amount of time, it's 1 year and 5/12. So it's 1 and 5/12 years, because we have August, September, October, November, December in 2021, and then all of 2022. So it's 1 full year plus 5/12 of 1 year. Again, the N needs to be in years because this is a zero interest bearing note. And so we use an annual percentage rate and annual amortization in that whole process. And so then when we solve this, we put all our information into the time value of money calculator, and we solve it, and we get 6.17%. And so for this problem, I'm going to round to the nearest hundredths. Somebody asked the questions. Yeah, so they are not printed. What I'm going to do, I had students in the first session ask about this. The other ones, I think all of the other blank ones are done now. And so what I'll probably do is I'll post those blank ones on Canvas, and then after we populate it, I'll post the completed version as well. And so you'll have both. And so I'll try to post those soon, so that you're going to see this, and you'll see this completed. And I guess some students probably would find it easier to use this to take notes and things like that. And last fall when I did it, I kind of had a different purpose behind these review sessions, and so this spring, I think it's better I'm going to post them. Okay, so now we have the TVM information. On the test, I would tell you where to round, whether it's hundredths or whatever. And so in this case, we're just going to use hundredths. So now we have our journal entries. And so the first journal entry is, let me fix this real quick. First journal entry is, of course, the issuance. All right, we'll get that in a second. So 8/1/2021. And of course, the company receives the copyright. It really does not like this, does it? Company receives the copyright. Whatever. And the fair value of that copyright, we use the present value of the note because that is more reliable. And so we use 113,000 because again, the 115,000 is not reliable. So we ignore that. And then the other half of that transaction is part of the note payable. But remember, the note payable is carried at its face value, which is 123,000. And so, of course, we have a situation where we have a copyright with a fair value of 113, a note payable with a face value of 123. And so the way we account for that difference is through the discount. And that discount is $10,000. Again, with a zero interest bearing note, there will always be a discount. And so as you march through time, there's really three things that can create a journal entry with debt. One is a payment, some sort of interest payment. Second one is whenever the debt matures, then the debt is paid off. And then the third one, which a lot of students forget about, is any fiscal year end. So whenever you come to a fiscal year end, you have to partially accrue and do things like that. And so it's really important that you pay attention to fiscal year ends. Somebody asked what makes the 113 more reliable, and it's the different level of fair values. And so with a note, most companies have other debt or public markets of debt that they can compare this note to. And so that makes the note a level 2 fair value. A copyright, by definition, is a unique item, and therefore a copyright is a level 3 fair value. And so we're always going to use the more reliable. Level 2 is more reliable, and so we use the 113 over the 115 because it's more reliable. And so now as we march through this note, the next event in the life of this note is the fiscal year end at the end of 2021. And again, the things we need to pay attention to, we do know that because time has been passing, we must record interest expense. And then we have to think about, okay, how do we calculate that interest expense amount? Again, there's two things that sort of go into the calculation of an interest expense. The number one thing is if there's any contractual obligation to pay interest, like if there were interest accruing on the note. In this case, there isn't, so we don't have to worry about that. But in most cases, there is. The second piece is if there's any amortization of a discount or premium. And of course, in this case, we do have a discount on the note, and so we need to amortize that discount. And so the interest expense for this problem is derived only from the amortization of the discount. And so the second half of this transaction is the discount, if I could spell. And so now we just have to calculate the entry amount. And again, we have to use the effective interest method because this is a long-term note. And so we have to use the effective interest method. The way we do that is we take the initial carrying value of the note, which is 113,000. We apply the interest rate, which is 6.17%. And then we figure out, well, how much time has passed between the issuance and the fiscal year end? And the answer is 5/12. So five out of 12 months. And so when we do that math, we get 2,905. And so the journal entry for both is 2,905. All right. And again, if you have any questions, just put it in the chat or unmute yourself and you can ask. And so then we just keep marching through time. Well, again, so Abdullah, when you talk about simple interest versus compound interest, you're usually talking about the terms on the note. In this case, there's no contractual interest, and so technically speaking, when we're doing this, we are using a compound interest. TVM is a compound interest method, but again, there is no contractual interest, so there's never any interest on interest, if that makes any kind of sense. And so it's just the distinction isn't quite right. If it was a 3-year note, 100%, you would need to use an amortization table. Because this is 1 year, we really don't have to. I'm sorry, just over 1 year, we really don't have to. 15, it's 5/12. Someone asked for the N, it's 1 and 5/12. I don't know if I can make a bigger space. It's 1 year and 1 and 5/12 years, not 15/12. It'd be 17/12. Yeah, I could put a plus. That's a good point. I don't know if I can, something like that. It's 1 and 5/12. All right. So the note continues, and really with an amortization table, there'd be sort of this interim step that's a little awkward sometimes for students. But really, there's kind of a shortcut, which is that the next journal entry is at the end of the note, 2022. We know that time has still passed, so there's still interest expense that we need to accrue. At the same time, we are going to repay the note. Of course, we need to amortize the remaining discount, and we're going to make the cash payment. We're going to do the cash payment in the note first. That's the easy piece, which is just the contractual obligation to pay. And then with the interest expense, if you had an amortization table, you could calculate it. You'd have to sort of take a partial year and add up and some things like that. You could definitely do that. However, there's kind of a bit of a shortcut, which is if you kind of think about with the discount itself, I'm going to kind of, let me go to the bottom. The remaining discount amortization is just the balance in the account. Because by the end of the note, the entire discount needs to be amortized. And so that $10,000 needs to go away. We had previously amortized $2,905, which means that the remaining amount is $7,095. And so we know that the amount of amortization for the entire year of 2022 must be $7,095. $7,095. And so that's just a shortcut way. If we had an amortization table, you would be able to add up columns and do some things like that. Again, but with a short-term note, or not short-term, but a note that's less than 2 years like this, it's really an amortization table isn't necessary. But any more questions on the note? Because we're done. That's the journal entries for the note. So someone asked where'd that number come from? Again, the discount balance is $10,000. We know that over the life of this note, all of that needs to be amortized. We previously amortized 2,905. I'll just highlight the right one, 2,905, which means the remaining amount to be amortized must be the original balance minus what we previously amortized, and that gives us the amount of amortization for the remaining 12 months. So for the problem on a test, it would probably be one or two of these journal entries. We don't know which ones, and I might have like two problems. You know, the first problem might have you do this journal entry. The second problem might have you do this journal entry or something like that. If I have like a multiple year kind of a problem, I would probably give you an amortization table. You wouldn't have to like create the amortization table and then also do the journal entries. So I just break it up into pieces. Any other questions? Okay. So now the next one. So this is a bond. Company issues $231,000, 10-year, 7.5% annual bonds. They issue them on July 1st, 2020, and they're issued at 102. And if you remember, that's the percent of the par value. So it means they're issued at a premium. The bonds pay interest on June 30th, provide all journal entries for 2020 and 2021. Again, we're doing a longer problem here. This kind of problem will be broken up into many pieces on a test. And so you wouldn't have it all in one. But we do need to kind of figure some things out here. So first of all, just like with a note or any other long-term debt situation, you need to apply the time value of money. And so we're going to use the contractual elements of of this bond in order to do that. First thing, whenever you see the $231,000, that tells you that is the par value. That is the amount that the company, 49er company, is obligated to pay at maturity. And so that's why it's negative 231,000. The second piece of this is, I guess the easy piece, this 10-year. So you put a 10 in for N because it's a 10-year annual bond. If it were a 10-year semi-annual bond, then the N would have to be 20 because it'd be 20 semi-annual periods. But because this is an annual bond, it's a 10-year bond. The I/Y we'll talk about here in a minute. we're going to talk about these two pieces right now. So first of all, let's talk about the payment. So the 7.5%, that's the bond rate. That's the stated rate on the bond. And so that tells you that the payment is 7.5% of the par value, which is 231,000, which means that the payment is $17,325. And the reason why I put a negative, again, is because 49er Company is making these payments. They're not receiving them, they're making the payments. And then the present value, we have to be given some sort of price. And so on a problem, either you'll be given the yield or you'll be given the price, and you kind of solve for the other one. In this case, you are given the price, that 102. So the price is 102% of par, which is 231,000. And so the price is $235,620. And again, that's positive because that's how much the company is going to receive when it issues these bonds. And then we solve for the I/Y, 7.21%.
May I ask a question?
Yes.
Why don't we do negative on a present value since we're just borrowing, so we don't have to do negative on PMT and future value? It's,
Yeah, so I think it's really important to think about the economic flows in order to ensure that you're doing the TVM correctly and you don't get something switched. If you did this one negative and both of these positive, you would still get the right answer. But if you did this positive, this negative, you'd get the wrong answer. And so I always want to think of, from 49er Company, where are the economic flows? So today, the present value, they're receiving cash. So I want to make that a positive economic flow. Whereas with their payments and at maturity, they are making a payment. And so that's why I make those a negative. And it just helps me make sure that I keep everything on track.
okay, thank you.
Could you get it right without doing that? Yes, you could. I do think you run the risk of making a mistake, though. So now that we've got all the information, now we can solve for the I/Y. So someone asks, how can we find that? Again, this is using your TVM calculator. And so the live lecture walks you through exactly how to do it. And so hopefully you can review that live lecture. You put in the information into your buttons on your calculator, like mine's right here. So if I wanted to put in the different buttons, I use that row of TVM buttons, which is right here. And I put all the information in and solve. So hopefully you're able to review that through the live lecture. All right, so now that we have the TVM, now we can use our amortization table. So again, this is a couple years, and so you're going to need to do an amortization table. Again, on a test, I wouldn't have you do everything. I would probably have you do TVM in one problem, and then with a different bit of information, do an amortization table, and then with different information, start doing some journal entries and things like that. But now we're going to complete this amortization table. So the first line, of course, is the issuance, 7/1/2020. At that date, there's no payment, there's no interest expense, there's no amortization. But of course, there is a carrying value, which is the initial carrying value, $235,620. So that's how we get started. And then we just go through our payment dates. So 6/30/2021, 6/30/2022. And the reason that I can stop there is because I'm only doing journal entries through 2021. And so now I've taken myself all the way through the end of 2021. And so I don't need to keep doing. Of course, there would be 8 more rows on a full amortization table. I just don't have to do that. So as we think about these problems, understand when we come to the 6/30/2021 row, what we're saying is this is sort of what's accumulated from 7/1/2020 through 6/30/2021. And so over that 12-month period, the total payment that is due is $17,325. And then the second piece is, well, how much interest expense has accrued? Well, the way we do this through the effective interest method is we take the previous carrying value and we multiply it by the bond yield, which is 7.21%. And so our interest expense over that 12-month period is $16,988. The difference between the two then is the amortization of the premium, which is $337. And that amortization reduces the carrying value of the bond to 235, 283. And so again, now the carrying value has been reduced by the amortization amount. And so now this next row is looking at, okay, what happens from 7/1/2021 through 6/30/2022. And again, the contractual obligation is the company must pay $317,325. The interest expense, again, using the effective interest method, is the previous carrying value times the bond yield of 7.21%. And so the interest expense is $16,964. The amortization is the difference between the two, $361. So the new carrying value is $234,922. And that process would continue for another 8 years. But of course, we only need to go through here because now we've taken ourselves all the way to the end of 2021. There's no reason to do any more calculations. All right, so how are we feeling about the TVM and the amortization table before we actually start doing journal entries?
You have those lectures posted under the files, right?
When you say lectures, what do you mean by that? I'm sorry.
This one right here.
Oh, yes. So I'm going to post this after we're done. Yep. Okay. So let's now start doing the journal entries. So the first one is the initial issuance, 7/1/2020. And on that date, of course, they received cash. I'm going to give myself some space. They received $235,620. Again, that's the price of the bond, the 102. The bonds payable are always carried at the par value. The par value is $231,000. And because this bond was issued at a premium, there's an additional credit to the premium for the difference, which is $4,620. Again, so the carrying value is the combination of the bonds payable and the balance in the premium on bonds payable account. If this had been issued at a discount, then the carrying value would have been less than the par value. And instead of having a premium balance, we'd have had a discount balance, which is kind of similar to the problem up here, but it'd be discount on bonds payable instead of notes payable. But again, this is a premium, and so it's a credit balance. So then again, just like the note, there's basically 3 things that are going to trigger a journal entry. 1 would be an interest payment. 2 would be the maturity, or 3, a fiscal year end. Someone asks, would you amortize the premium to spread it across the 10 periods? So again, with a non-current, if you use the straight line method, yes, you could do that. With this one, we're using the effective interest method. And so when we talk about amortizing over the 10 periods, yes, but understand the amounts would continue to change because the carrying value would continue to change. But yes, we would have 8 more periods, and so the full amount would get amortized over the 10 periods. And so again, with this one, the next event in the life of this bond is the fiscal year end for 2020. And so we do know that time has passed, so we do have interest expense. Again, the premium amortization is a continuous process, so we need to make sure that we amortize that premium. Unlike the 0 interest-bearing note, there is a contractual obligation to pay interest on this bond, and so there will be interest payable. And so if you remember when we were up here, I said, oh, the interest expense is a function only of the amortization of the discount. Down here, there's 2 things that go into how we calculated our interest expense. One is the contractual obligation to pay interest, and the other is the amortization of the premium. But notice they slightly offset. And so just understand that these 2 things together allow us to derive the interest expense. The amortization table that we created up here already does this for us. And so in other words, when we calculated the interest expense, we accounted for the amortization of the premium and the contractual obligation to pay interest. And so together, that's how we got to that interest expense. And so just understand that while we still are deriving the interest expense, the amortization table allowed us to directly calculate the interest expense. And so when we calculate this amount, I'm going to put in the amount and I'm going to show you how we got it. So the interest expense is $8,494. And the way that we calculated that was the full year of interest expense is $16,988. But of course, only half of that was accrued in 2020. Because remember, this is the interest expense from July 1st, 2020 through June 30th, 2021. So this $16,988, that's 12 months of interest. 6 months of that was in 2020. The remaining amount is in 2021. Similarly, when we amortize the premium, the $337 is a full year, but of course we only have half a year as of December 31st, 2020. So we take the 337 and multiply it by 1/2. And then with the interest payable, very similarly, the full amount of interest would be $17,325, but of course we're only accruing half of that. So 17,325 times 1/2. Again, the reason why it's interest payable is because there is a contractual obligation to pay interest. And so we do need to make sure that we accrue that. Okay. Any other questions? Before we have 2 more journal entries on this one.
On the test,
Yes.
sorry, on the test, would you, would you tell us if it's effective interest or a straight line, or would we just? Okay.
Yep, I will tell you. Good question. I will say for any workout problems, it's going to be effective interest if it's at all involved. If the straight line method honestly is very rarely used anyway. Almost all companies use the effective interest method, but it's still allowable under GAAP, so we still teach it. Although under IFRS, it is not allowed. All right, so 6/30/2021, we do have an interest payment on that date, so we need to record that. And so again, time has continued to pass, so we do need to record our remaining interest expense. We do need to continue to amortize our premium. Since we're making the interest payment, the interest payable goes away. And of course, we're paying with cash, so we need to record that. The easy part, of course, is the cash payment, $17,325. Also, hopefully the interest payable is fairly obvious because we just accrued it. So we had accrued the $8,633. Let's talk about the interest expense and the premium. Again, just as a reminder, I'm probably beating a dead horse here. I apologize, but remember, this $16,988 is 12 months of interest from July 1st, 2020, all the way through June 30th, 2021. So over that period, we need to accrue in total $16,988. We already accrued $8,494 at the end of 2020, which means that the remaining amount, the remaining $8,494, needs to be recorded on June 30th. And so that's where we get that number. I'm just going to take the 16,988 and subtract what we previously accrued, 8,494. Very similarly with the premium, we know that in total, we need to have accrued, or we need to amortize $337 over that 12-month period. We already amortized $169, and so we just have to amortize the remaining $168. So we take the 337 minus 169, and that's where we get the 168. So again, we just have to systematically think through what each of these rows represents, and hopefully that allows you to get to the right answer. Any questions before we jump to the final journal entry? Okay. So 12/31/2021. Very similar to the 12/31/2020 journal entry. Time has passed, and so we have to accrue our interest expense. We need to amortize our premium, and we need to recognize the fact that we have accrued interest, contractual interest on the bond itself. The contractual interest is still $8,663. That hasn't changed. And the reason why it hasn't changed is because the payment is the same throughout the life of the bond. So that's still $17,325 times 1/2. Now the interest expense amount is going to be a little bit different. And the reason why is because now we've moved down a row. Remember, this row represents the interest that accrues from July 1st, 2021, and the day after this previous row, from July 1st, 2021, all the way through June 30th, 2022. So December 31st, 2021 lies halfway in between that, which means that this interest expense total, $16,964, half of it needs to accrue as of December 31st, 2021. And that half then would be $8,482. And again, that's the 16,964 times 1/2. Similarly, the amount of the premium amortization is going to be based on the next row. And so it's going to be 181, which is that $361 times 1/2. And of course, that would continue on. So then if we kept going on June 30th, 2022, we'd have a payment. We accrue at the end of 2022, and on we would go until the bond matures. Does that make sense?
Yes.
Perfect. Perfect, perfect, perfect. Thank you. All right, so next and final question. This is actually an easy question, but one that students miss all the time. So I thought, well, why don't I just explain it one more time and hopefully we can get this figured out. All right. And I'm just going to write down a concept that's absolutely critical to just accounting in general. All right. So when we talk about debt, all right, whenever debt changes hands, anytime debt changes hands, the total payment is always going to be the price plus any contractual accrued interest. This is just sort of a truth that we need to understand in accounting. Oh yeah, so somebody asked when it doesn't tell you. So on all my tests, it's a December 31st fiscal year end on every single test. I even write it in the test notes, like assume December 31st fiscal year end. So I won't say there's a fiscal year end, but by default, every single problem has a December 31st fiscal year end on every single test that I give. Good question. But anytime there's a transaction, the total payment equals the price plus the contractual accrued interest. Now, in these previous two examples, there was no contractually accrued interest here, and there's no contractually accrued interest here. So the only thing we had to worry about was the price. That was it. But on this problem, we do have an issue. Notice that the bonds pay interest on December 31st of each year. Now, that December 31st contractual interest payment is based on the terms of the bond, all right? And that cannot be changed. That's just the term of the bond. However, notice what happened. It didn't get issued until March 1st. It should have been issued on January 1st, but for whatever reason, it didn't get issued until March 1st. And so basically now we have 2 months where interest had accrued on the note, on the bond, but where the holder of the bond isn't really entitled to that interest. And so what that means then is that whenever the company issues the bond, the borrower, I'm sorry, the purchaser needs to pay for the bond, and they have to kind of prepay that interest because they're not entitled to it, but they're still going to receive it on December 31st. They're going to get a full interest payment on December 31st. And so we've got to make sure that that the issuer is compensated. And so when we do this calculation, then The price, we're told, it's issued at par. And so the price is 150,000. Oops, let me do this. 150,000. And then the contractual accrued interest is based on the terms of the note, which is 150,000 times 9%. And we have to figure out how much accrued. In this case, 2/12. Because January and February passed before the before the bond was issued. And so again, we get 150,000 plus the interest, which is $2,250. And so the total payment is going to be $152,250. So that's how much cash the company is going to receive at issuance. The price, which is the par value, plus the accrued interest, which is $2,250. You're going to see this idea come up again in chapter 17 when we start dealing with debt investments. All right. Any more questions? Okay, I'm going to stop sharing here. Now, the 8:30 session video is already up and running, but for this one, it'll be up probably, I'm guessing, the next half hour, 45 minutes. It usually takes a little time for it to, I don't know, whatever it does, create the video, and then I'll post it. So for a problem like that, yeah, I mean, the big thing is whenever I ask these questions, only answer the question that I ask. But I mean, the nice thing is it's an online test, so the framework's going to be such that there's just going to be a space. So it'll be like, how much cash did they receive? And you'll have to put in the number. Or it'll be like multiple choice or something like that. So for that kind of problem, it's pretty straightforward. I think in the notes, I actually went through and did the journal entries as well. And so, I mean, look at that. But the biggest challenge to that problem, I think, is getting that number right. You know, how much cash? No problem. Any other questions?
Is the test on Lockdown browser?
It is. Yep.
Okay.
And it uses the monitoring thing as well. So there's a practice test, though, that uses both. And so take that practice test and it'll force you to get used to using that software.
How long do we have for the test? Did you say 2 hours?
Yes. So you have 2 hours.
So are we able to start it before our class time? Because see this class at 10 and then I have another class at 11:30. So am I able to start it a little earlier so I have the full 2 hours?
Yes. So I think the test window opens at like 7 in the morning.
Oh, okay.
And it closes at like 12:30. So,
Okay.
I mean, there's hopefully a big enough window. And there's a few students who actually have like classes that are back to back to back to back to back, and they literally can't do it. And so there's another test window in the evening just for those students who have just a scheduling conflict that cannot be moved.
Okay, perfect. Thank you.
The practice test is already posted, and yes, it is open book, open note. The only thing you can't have is like a phone or something like that. You can't have an electronic device.
You can have a calculator, right?
Absolutely. Yep.
And how many questions?
Oh, let me look real quick. This first one, it might say on there, the first one's 31 questions. And so the length varies. You know, some of them, the shortest test is only 21 questions. But this one's 31. And some of them will take you 5 seconds to answer. Some of them take longer, obviously. Yeah, no phone, no phone, no phone.
So the 2 hours should be enough, correct?
Oh yeah. I mean, if it's not, it's not because the test was too long. It's probably because you don't know the information well enough, would be my guess. And I will say this, please, please, please hear me out when I say this. Just because it's open book, open note, it doesn't mean like, oh, I don't have to worry about studying. I'll just look up all the answers. That will not work out. I'm just going to tell you that is not going to work out. So take it as if it's closed book, closed note, And then I'm telling you, you will do very well, because then when you're going through the test, you might have one little thing like, oh, I forgot that. I can look that up and I'm good. But if you have to look up every answer because you don't know what you're doing, you're going to run out of time. So with the online, somebody asked about using the online. No, you won't be able to use the online. You could print those pages out and have them accessible, but you will not be able to have access to it on a screen. And you cannot use an iPad either. I'm sorry. You're gonna have to print them out. Just because, so the thing is, so there's this old saying in the Air Force, and you're probably like, it's not overly crude, but it's a saying we used to say. It's like, if one person wets their pants, everybody has to wear diapers. Great military saying. So the fact is, the reason why I have to do all this stuff is because guess what? Some students, if you don't, they start texting each other in the middle of the test. Like, hey, what'd you get for this? And what'd you do there? And it's like, now all of a sudden I'm policing everybody and like, oh, what am I going to confiscate look at your text? I can't do that. And so now all of a sudden the students who are trying to do it right are getting disadvantaged. And so, yeah, I just don't allow any electronic devices, just because I can't really control what you're looking at and what's going on. But I'm sorry about that. Yeah, it kind of stinks, just kind of the way it is. You are able to skip questions and go back. Yep. The test is not mostly theory. It is not. It is not. It is not. It is not. It is mostly calculation, journal entry type. There are some theory questions, but it is not mostly theory. The material is not mostly theory, so the test can't be most. Well, I mean, I could, but it just doesn't make sense for it to be that way. Is the test through Wiley? No, I wrote the test. It's given through Canvas, but I wrote the test. Wiley did not write this test. I did. See if I missed any. I'm going to scroll back up. So as far as the mix of multiple choice free response, it's mostly fill in the blank-ish, like either like a number or a calculation. There are some multiple choice, maybe a few drop-down menu kind of questions, but I don't think any of the questions are an open text box field where you have to fill in. I used to do that, and I figured out that that ends up being kind of a disaster for grading purposes. And you spend a lot of time trying to worry about formatting, and you're kind of like dealing with that. And so I just spent the summer, honestly, just making sure the test was as clean as possible in terms of grading, and for students to make sure they can demonstrate that they're not getting hung up on format. I don't want you to get hung up on format. Do I have answers for the test? So I'm not sure what that means. You will not see the answers to the test, obviously. Even when you're done, you won't see the answers because I reuse the test questions. Obviously, I have the answers because I have to have the answers. And what I usually do is afford an opportunity, if after the fact you want to go through it, we'll have a video chat session where I'm watching you and we'll go through your test. And some students use that, but you will not have access to the answers yourself. Because again, I reuse them, and I don't want to keep writing new tests every semester. Do you have a solved version? Oh, you know what? That's a good question. That one, I'll see if I can change the settings so you can see the answer. That's a good point. I mean, I have the solutions, obviously, but I don't know if you have access to that. That's a good point. I think I can do that. I'll check. Good question, though. You will see your grade immediately once you're done with the test, but that will not include a curve. All my tests have a curve. It's the first one I'm going to tell you right now is probably going to be a 10-point curve. It may not, but it probably will be. What I usually do is I kind of look at the top group of students and I kind of get a gauge for how they landed. There's 80 of you or 90 of you taking the test, so I can kind of treat you as a distinct group. If there were only 20 of you, I'd probably have to combine you with like previous semesters to get an idea. But every semester, Yes, every semester I've ever taught this class, the first test has had a 10-point curve every time. So I'm guessing it'll be a 10-point curve again. But you won't know that until probably later that evening or maybe the next day. You won't know your curved grade, but kind of count on ballpark 10. Any other questions? All right, everybody. Oh, 10 percentage points. Well, it's 100 points, so 10 points and 10 percentage points are the same. All right, everybody. Well, thank you so much for your time. Enjoy your break and study hard. Do well. All right. Thank you.
Thank you.
Bye.